So welcome again to another video on this channel, guys. It is my pleasure to speak to you today, and in this episode I'm going to be specifically talking about two things. The first thing that I'm going to be talking about is why it is so hard for beginner and intermediate forex traders to actually scale their accounts, flip their accounts from small accounts to big accounts, and how you can actually do it if you are a beginner forex trader or an intermediate forex trader, because I know a lot of people who are going to be watching this video, most of them, if not all, are people who are still struggling to, they're trapped in the rat race of trying to grow small accounts to big accounts, and they're just blowing accounts time and again, donating their funds to the market. So we are going to be talking about how you can actually overcome this and become a trader who is profitable and a trader who can grow an account from a small account to a big account without too much struggle. So the first thing that I want to mention is that unrealistic expectations. Unrealistic expectations are the reason why so very many traders who are starting, they will fund an account, blow the account, and then take a break from forex. They call it a scam, blah blah blah. And then after some time, they see that maybe their friends are still trading, or maybe they just have too much struggle getting other income sources, and then they decide that they want to still come back to the market and trade. So they continue this cycle of blowing accounts, taking breaks, coming back without actually finding an edge in the market to trade. So here's the thing. If you want to actually successfully flip small accounts to some substantial figures, you need to first fix your psychology. What do I mean by fixing your psychology? First of all, we need to understand that you cannot come into the forex market. You want to fund an account, let's say majority of you I know, even you who are watching, you actually fund between $10 to $100 in most cases. That is where most beginners can afford. So you fund $10 to $100, and then you're expecting to maybe take that figure to about $300, $500, $1,000, some even $10,000, and you want to actually do this in a week, a month, some unrealistic targets. So is it possible to grow an account from $10 to even $1,000? Yes, it is. But for how long will you be able to do that? That is another thing that we need to discuss. So realistic expectations of the duration that you need to grow a small account to a big account, and the psychology behind doing this, is what we are going to be focusing on so much more. So for the first thing that we need to understand, growing a small account is very delicate. You need to have realistic profit targets. You need a clear entry strategy and a clear exit strategy. We are going to be focusing on things like greed. You have to battle a lot of greed, because maybe you've entered a trade and maybe you are risking something like $5 or maybe $2. It depends with the account size, if it's $100 or $10. So the truth of the matter here is, with a small account, you cannot expect to risk 1% to make 3%. It is a very disciplined approach of making it in forex, but again, it won't work if you are using a small account. You'll end up just becoming greedy, because the figures you're seeing on that screen, the floating profits, will not make sense to you. So that is why we are going to be focusing on building that psychology to enable you to be able to get this right and train your mindset so that you can easily go into the market. Don't be greedy, be patient, wait for your setup, and then start your journey to growing a small account to a big account. And if you guys want us to be able to do this, you can tell me down in the comment section. We can just start a small account of like maybe $10, 20, 50, 100, and then try to grow it to about $300 or $500, because those are realistic figures that are achievable in the forex market. So the truth of the matter is, for the first time, when you are doing this, you are going to be risking anywhere between 30 to 50% of your account. And whenever you risk 30 to 50%, our RR, those who don't understand what an RR is, it is the risk to reward ratio. Your risk to reward ratio needs to be at least 1:2. Yeah, you are. Let me see if I can get a text to just write these things down, because some people, their concentration span will not allow them to just follow along my words. So I'll be typing these things on your screen so that you can see. Um, we are talking about flipping small accounts. Okay. So number one, we are talking about the risk management approach. Here we've said that you're going to be risking anywhere between 30% to about 50% of your account. And you're going to be aiming for a risk to reward ratio of 1:2. The reason why I'm insisting on 1:2 is because it is so easy for you to get that 1:2 risk to reward ratio compared to 1:3, 1:4. You might actually get that 1:4, 1:5, even 1:6 sometimes if you are lucky. But again, you have to understand the fact that we don't want to gamble. We want to secure profits, because what matters at the end of the day is not going to be what was floating on the account, but actually what we are closing in the balance. It's not about a game of floating figures. You'll float the figures, take screenshots, but again, the market will reverse against you very fast, either take you out at break even or even hit your stop loss. So we are trying to avoid that thing of the market doing that to you. So 1:2 is very quick. You are risking $3, you make $6, you are out of the market. If your account was at $10, it is now at $16. If you do this again, risk $3 to gain, you'll easily be at that is $12. You'll have made a profit of $12 if you're trading on uh, a $10 account. But if you're trading on $100 account, risking 30% is basically $30. You risk $30. That is like, if say you're using 0.1 lot size, you're going to look for a trading opportunity where you are comfortable enough to, it's a high probability trade. So in this high probability trade, you are going to be focusing on risking about 30 pips to make like 60 pips. But again, 30 pips, 60 pips, most markets don't actually move 60 pips in a day. That is the truth, and it's what I've observed in the forex market. So the realistic targets that you're going to be talking about is like, just focusing on pips like about 25 pips to 30 pips. That makes sense. It is very possible to get up to 30 pips from the market in a single day. So if you're going to be aiming for 30 pips, it means you need to be finding an opportunity where you can actually risk only 15 pips. And if you're going to be risking 15 pips using a 0.1 lot size, that means that you'll be getting I think $1.5 per pip. So you'll need to use maybe a 0.2 lot size for you to be able to risk $30 on 15 pips. I'm saying this because I'm assuming that you have the basic knowledge of calculating how pips actually work. So if you are risking 15 pips and you have two positions with 0.1 lot size, that is $30 on the line, you are aiming for 30 pips. If you actually make that 30 pips, it is going to be very, very possible for you to actually make $60. if you do these 3 days, $60 times 3, if those high probability setups play as per your anticipation, you'll have made like $180. But should you happen to lose one trade, because let's assume your winning rate is like 50%, it means that if you got if you took 6 trades and you're making $60 per each setup. So let me just write this here so that you understand the math that I'm talking about. You've taken 6 trades. In these 6 trades, your win rate is 50%. We are looking at a scenario whereby you've won 3 trades, and those three trades, you are making $60 on each winning trade. So that is like $180 that you will have made on the winning trades. Now let's talk about the losing trades. You will lose 3 trades, and whenever you lose, you are losing $30. So it means that you'll have lost by the end of 6 trades. If you lose 3 trades and you win 3 trades, so you'll have made like a $90 loss. So let's just put a minus there so that it will be easier for you to follow along. Now 180 minus 90, it means that you'll still be $90 in profits. You understand? So if you keep doing this, if in every week you take 6 trades, although I'm not sure, it depends with your strategy. Some people might just be able to find 2 or 3 opportunities, so that will tell you how many weeks you will need to take to, get to like $500. If you do this for like for example, for me, I can manage like 3 to 4 trading opportunities in a week. So I'm seeing a scenario where, if let's say I'm taking those only 4 trades in a week and I win 2 trades that I win, I'm making $60 on each. That will be $120 on the profit side. And then if I lose 2 trades, and for each trade I'm risking $30, so I'll be at $60. It means I can be able to make $60 in a week realistically, without doing too much trading, over trading, and just following my actual plan. So if I do this consistently for like the first like 3 weeks, 4 weeks, I'll have made like if I keep taking the 4 trades and I'm making profits of $60, you understand that math? I'll be making how much? If I net after the profit and losses, I net like $60, for example, then this is my weekly profit. So if I do this for like maybe 5 weeks, I'll have made a profit of like what? $300. But now here's the thing. When your account grows, you are at $100, you've made a profit of $300, now you're sitting on $400. The lot size that you are using will also increase. So you'll just adjust the lot. If you are using 0.1 on $100 account, you are going to do this when you get to $200. You'll be using now 0.2 lots. If you are opening one position on $100 account, or 2 positions, you'll just do the same, just increase by an extra lot. So if you are using 0.1 on $100 account, you'll be using 0.2 on a $200 account, 0.3 on a $300 account, and this will be very easy for you to get to $1,000 or $500 if you are actually doing it correctly. Remember, no over trading, because if you want to trade like 10 positions in a week and your strategy doesn't allow that, you just need to wait for your confluences to align and then for you to take your trade. So I don't know if whatever I've said kind of makes sense, but I want to assume that you are getting the concept and the psychology behind flipping small accounts. If you raise 30%, it means that you actually have three shots before you blow that account. Now you have to make sure you know how to evaluate your trading strategy. Always make sure that your first trade is going to be a high probability trade, extremely highly probable trade, because thoroughly if you win on that trade, it will set the momentum for the rest of the trading scenario. So you need to understand that as well. Sorry about the noise. I don't know where it's coming from, but let's just focus on what we're talking about. If you actually do this successfully, you'll be able to, grow your account flipping skills. You need the right mindset, you need the right patience. It means even if you were to start this week, and this week you're not seeing any highly probable trade, that is where discipline comes in. Just wait for next week. There is no hurry. There is no hurry. Again, this thing you have to, don't try flipping small accounts for urgent needs, because that will lead you to trying and over risking. You are looking for trading opportunities where there ain't any, so you'll be forcing trades basically. But if you focus on waiting for the right setups to appear, then my friend, you will be on the right path. So let me know down in the comment section if this is something that you want us to try. We can organize for maybe some days. We can be doing live calls, uh, live trading sessions, that is, and then we try to basically flip accounts and see where we can actually get to. Also, something else that I wanted to say, I'll be pinning my, if you want to get a funded next account, I can give you my link down in the description below, so that you get a 5% discount when you are making that purchase. Hopefully, if it's your first time using funded next, using prop firms gives you the ability to trade huge capital. You just have to demonstrate that you have the skills, and then they'll assess you from phase one, phase two. They'll give you a certificate if you pass each stage, and then once you are funded, whatever profits you make in a month, they take like I think it's normally funded next, they take like 25%, if I'm not wrong. No, 20%, meaning that you'll, if you make like $3,000 or $300, they'll give you 80% of that, and they'll keep 20% as their commission. So that is also something else that you will need to consider. If you are struggling with small accounts, you can actually consider getting a proper account. It's good because it will give you a wide room for error, because you see like an account of I think $10,000, you can be able to get it at around, I don't know, for me, I know I have been trading a $50,000 account, and it goes for a little less than $300. It's $299. So if you get an account like that, you see you have so much room for error. I'll be showing you my funded account in the next episodes. So it is my wish that you actually keep coming back to this YouTube channel, and we'll be discussing now about that. Thank you guys, and do have an amazing time.